course, the price keeps moving higher, you find that these players make these moves prior to the price moving, using the suppression of the COMEX market and the LBMA to their advantage. And there are those that think like Eric Young, the King Kong on X, who believes the Chinese are doing the same thing with silver, shorting the paper price in New York and buying physical in non-price setting locations around the world to accumulate it at subsidized prices. They're playing the game, a long game, to drain the shelves. And I guess what I would say is that when players at that level stand for delivery to the degree that they have, there's something much bigger at foot than any analyzing would ever tell you. It's just simply these people don't make these kind of moves in a preemptive fashion without knowing what's coming or having a very good idea of where things ultimately go. And here we are looking at silver, where today...
So like 36.75, I believe?
Yep, and you got it. The futures are up $1, up 2.81%. So we're talking something's going on. And silver is now, this is the third time in history it's been this high, which is kind of crazy if you think about it. And when we get through this resistance in the mid 40 range, there's nothing standing in front of it. And I guess Vince Lancy made a great point, and he said, silver is where gold was 18 months ago or however long ago before it started to make its move. And on a technical level, this long building, 45-year cup and handle base building, it's right at the mouth of the cup, about ready to break through, and it's right, breaking through that resistance as we speak. So yeah, I think it's the action in the metals market that to me, along with deliveries, that is something that I pay real close attention to. This stuff doesn't happen just for the hell of it. And if you look at what's happening in China right now, by the way, silver closed yesterday at 38.29. This is the arbitrage that the Chinese and the Shanghai Exchange are using to entice anyone stupid enough in the West to sell our silver at a much higher price. But at 38.29 in Shanghai, they've been leading the price. In other words, we've been seeing this higher price level in Shanghai, and the metal keeps moving in that direction. So to say we're very close to this breakout phase, look, you get up into the $38, $39 range, there's very little ahead of it other than a couple of brief examples in 2011 and 1980 to act as support, as resistance. So yeah, I'm very bullish, very, very bullish on silver. But when we see the largest delivery in the May contract of ever in silver and gold, but in silver, I think people should pay very, very close attention. That technical analysis is very important, for sure, on this long-term cup and handle formation. But I think right now we're moving into a different era, where access to things like your wealth has greater significance, perhaps, than return on. It's more like return of. And in a world of counterparty risk accentuating and growing and systemic risk, there's a drive by some very sophisticated players, for sure, to stand for delivery. And that's what's different than ever before, Danny, is that it's easier to manipulate the market when no one stands for delivery. When people stand for delivery, and it's a very difficult thing to do, especially in those levels, it's sophisticated, it's expensive, things start to get very different. And it represents a systemic threat, if you will, to many of these shorts, the commercial banks who are foolish enough to continue to short the market. So yeah, it should be an interesting, if we can get past the close of this month above 36, I think the sky's the limit. We'll see if they try to hammer it down again, as they always have. But it just seems as though things feel a little bit different, reminiscent of gold right now.
All right, folks, let's just dive right into what's going on, because I'll be blunt. This is different. And I know we've all heard that before, maybe too many times, but I've been doing this for over 3 decades, and I can tell you with every fiber of my being, this market smells different, it feels different, and the moves we're seeing are not random. Now look, the story always starts with the big macro. You've heard me say for years, watch the central banks, watch the sovereigns, watch the biggest money in the world. They're the ones who know what's coming, and they're always early, always ahead of the game. The little guys, the retail crowd, they show up after the big moves. They're like kids who show up late to the yard sale when all the good stuff's gone. But this time, it's even more extreme. We've got retail in the US all in on equities. Record levels of stock exposure, according to Goldman's latest analysis. Retail is out there YOLOing into tech stocks and meme trades while insiders are quietly dumping. Just last month, institutional sales hit over $4 billion. Insiders selling their own shares at a pace we haven't seen in years. And who's buying? Mom and pop piling in with both feet. But flip that around and look at the metals markets. The exact opposite is happening. Retail investors in the West have lost interest. Premiums on most bullion products have collapsed. Everyone's lulled by this strange complacency that the dollar's fine, the system's fine, inflation was transitory, yada yada. Meanwhile, the biggest, most connected money on the planet is draining physical gold and silver out of the ecosystem at a speed that frankly makes me nervous. Just take what happened in May. We had the largest gold and silver deliveries in COMEX history. Let that sink in. Not the biggest in 5 years, not since the GFC, the biggest ever. About $8.5 billion worth of gold stood for delivery in 1 month, plus about 12,000 silver contracts. That's 60 million ounces of silver. That's not trading paper contracts back and forth and cash settling. That's saying, deliver me the actual bars. I want them now. Now, why is this such a big deal? Because futures markets weren't designed for people to take delivery. They were designed for hedgers, miners and jewelers and industrial users to offset price risk. You might get 1 or 2% of contracts standing for delivery in a typical month, but we're seeing sustained, heavy, month-after-month drawdowns. This is a sea change, and it's not just on COMEX. The LBMA in London is showing 8-week delivery delays when it used to be T+1. That's the most liquid over-the-counter market in the world for gold and silver, and they can't keep up. The Shanghai exchange is draining fast, even as China's encouraging its citizens through state-sponsored gold and silver accumulation programs. Think about that. The West is mocking gold as a pet rock, while Beijing is literally telling its citizens to go buy it and making it easier than ever. In fact, I read a tweet from Eric Young, known as King Kong on X, and he said he believes China is doing with silver what it's already done with gold. They're shorting the paper price in New York, scooping up physical in Shanghai or Dubai or Zurich at suppressed prices, and slowly draining the shelves. They're playing the long game. They don't want to nuke the market by making aggressive bids. They're happy to let the bullion banks keep shorting, keep pushing the paper price down, while they quietly hoover up every available ounce. And I'd say the same goes for Russia, for the UAE, for India. The difference is these nations are also opening up new pricing hubs. Shanghai is already dominant in gold, Singapore is opening new exchanges, and even Saudi Arabia is working with China to build vaulting capacity. You think this is accidental? No way. This is about shifting pricing power from the West to the East. Now, a lot of folks ask me, Andy, who's behind all these massive deliveries into COMEX? Is it China? Is it Russia? Is it some sovereign wealth fund? I'll tell you the truth. Nobody knows for sure. COMEX is opaque by design, but what I can guarantee is that retail is not taking delivery of $8.5 billion in gold futures in a single month. This is sophisticated, extremely well-funded money standing for metal because they see something coming. And I'd argue it's not just a hunt for yield. It's not even just an inflation hedge. It's about return of capital, not return on capital. It's about getting your wealth out of a system loaded with counterparty risk. And let's be honest, the global financial plumbing looks worse than it did in 2008.
I think any discussion about gold and silver without talking about the BRICS now is a mistake. And a lot of people would say, well, the BRICS is old news. I want to get to that later on because I think that there are some developments, Danny, that have happened within the BRICS framework that I haven't heard anyone talking about but me, about one thing that changes everything. I want to come back to that. I think the thing that I've been focusing on the most, really all year, has been the amount of gold that's been coming in to the United States. Now, we know that countries like China have been buying gold. In fact, they expanded their gold reserves for the 7th straight month in May. But that's happening all around the world. And that's something that should certainly not be ignored. But what's happening here in the United States? And when I mention gold, I mean silver too, which, by the way, is up over 45% year to date, which is outpacing everything in the metals complex. But when we talk about gold, to see the amount of deliveries coming into COMEX, and really no one knows who is behind it, is something that I think needs to be really contemplated in the respect that, as an example, the May gold contract and silver contract, the May gold and silver contract were the largest deliveries into the COMEX market in history. And this is just kind of a repeat, if you will, of everything that we've seen since really November, where month over month over month over month, we continue to see huge inflows into the COMEX market. Now, this is ridiculously different than anything that I've ever seen in this industry, ever. This never happened before in this industry. As a result, of futures contracts normally settling for cash. Now, all of a sudden, you're seeing these futures contracts settle in for delivery. And that's something that, 8.5 billion, if I'm not mistaken, in gold was delivered into the May contract. Now these are things that, forever, you would see maybe 1% of contracts stand for delivery. Not the sheer amount that we've been seeing, which is off the charts, and it's continuing. We've had somewhere north of 35 tons of gold stand for delivery since Easter of this year. And I think what we're really seeing is that private wealth is moving towards assets like gold and silver with no counterparty risk, and that's why they are standing for delivery. To me, that's the biggest thing, Danny, is that we're seeing a global rush, whether it be bleeding dry, the LBMA, to where they have to go to 8-week delivery delay from T+1, T being the trade day plus one settlement, the third day your metal should be moving, to T+8 weeks. A draining of the Shanghai exchange, where Chinese are promoting their citizens and prodding and encouraging them to accumulate gold and silver through state-sponsored gold and silver projects. So they are actually pulling it out of the Shanghai exchange, or the same thing happening on COMEX at a much bigger level, where the biggest money in the world, the most sophisticated money in the world, the most well-informed money in the world is standing for delivery. Now you can look at what President Trump said on Easter Sunday, a tweet on Truth Social and on Twitter, where he says, the golden art of negotiating, he who has the gold makes the rules. Thank you, whatever that means.
Now let's pick up where we left off, because I want to hammer this point home. We've entered a new era. This is not just a typical bull cycle for gold and silver. This is not like 1979 to 80. This is not like 2010 to 11. Back then, you still had relatively sane debt levels. You still had the illusion that central banks had this under control. Today, the system is saturated. It's like a junkie so far into his addiction that another hit might kill him. Let me give you a few stats that should make you pause. The U.S. national debt is barreling toward $35 trillion. We're adding $1 trillion every 100 days. And by the CBO's own admission, we're on track for $50 trillion by the early 2030s. And this isn't at 0% interest rates anymore. The average interest cost on that debt is now above 4%. That means roughly $1.5 trillion a year in interest alone. That's more than we spend on national defense. It's more than Medicare. It's more than any discretionary program. It's simply servicing old promises. So the question becomes, who's buying the bonds? Who's financing this monster? Because for decades, the answer was foreign governments. China, Japan, Germany, Saudi Arabia. They accumulated treasuries as the ultimate reserve asset, the cornerstone of their foreign exchange. But guess what? That story's over. Foreign holdings of U.S. treasuries have been falling. Japan and China are net sellers. The BRICS nations in particular are actively dumping. Saudi Arabia recently cut its U.S. treasury holdings to the lowest in over a decade. Why? Because they see what's coming. They see the printing press running hot. They see a Federal Reserve that talks tough about inflation, but in reality can't raise rates much further without imploding the entire system. The moment recession fears intensify, the Fed will cut. They'll pivot, they'll restart QE, and the dollar will sink. That's why you're seeing BRICS quietly accumulate gold. Russia, for obvious reasons, can't touch the dollar system anymore. So they've been stockpiling gold, over 2,300 tons officially. But analysts like Jan Nieuwenhuis argue it's probably much higher when you include sovereign wealth channels. China? They just bought gold for the 8th straight month, pushing their official holdings above 2,200 tons. But nobody seriously believes that's all they have. Between their strategic stockpiles, the PLA's holdings, the Communist Party's layered structures, most conservative analysts put China's real reserves closer to 20,000 tons. That's 5 times what the US claims. Now you might say, Andy, so what? They'll never admit it. Maybe not. But remember, if the dollar ever really starts to tumble in earnest, China can instantly stabilize the yuan by unveiling their gold hand. It's like an ace up their sleeve. If the dollar craters, they can say, hey, our currency is now implicitly backed by 20,000 tons of gold. Settle oil in yuan, settle copper in yuan. The game changes overnight. We're already seeing signs of this shift. China's opened foreign vaulting for gold, first in Hong Kong, then in Saudi Arabia. They're opening the Shanghai Futures Exchange to direct foreign participation. That means a foreign bank doesn't need a Chinese entity anymore to trade gold futures in Shanghai. That's a big deal. It's about building global liquidity pools outside of New York and London so price discovery can migrate east. And let's talk silver for a second, because it's even more explosive. Silver has always been the more emotional metal. It's smaller, the market is thinner, so when it moves, it rips faces off. Historically, silver lags gold early in bull cycles. But once it gets going, it outpaces gold dramatically. We saw this in 1979. Gold tripled, silver went up tenfold. In 2010, gold doubled, silver quadrupled. This is why we watch the gold-silver ratio so closely. Right now, it's still hanging around 80-1, but every time we've had a secular metals bull market, that ratio has compressed to the 30s or even 20s. What does that mean practically? If gold's headed to $8,000, just matching prior cyclical expansions, a 30-1 ratio means 266 silver. Even without gold moving, if the ratio just reverts, silver triples from here. And this time, it's not purely a monetary story. You've got industrial demand from EVs, solar panels, green tech, all these sectors guzzling silver. Eric Young, aka King Kong on X, nailed it when he said the Chinese are playing the same long game with silver they played with gold. They're shorting the paper price in New York, accumulating physical in Shanghai and Dubai, draining the global float at subsidized prices. It's genius, frankly. They're letting Western financial greed suppress the paper price while they scoop up tangible metal. And that brings me to the technicals. Because holy cow, this chart is beautiful. Silver's built a 45-year cup and handle, dating back to the 1980 Hunt Brothers mania. We're right at the lip of that cup. The last 3 times silver's poked into the mid-30s, it's pulled back. But each time the floor has been higher. It's coiling. It's like a beach ball being held underwater. When it pops, there's nothing stopping it until the high 40,000s. After that, it's blue sky. The Shanghai Premium is telling you the same story. Right now, silver's trading around $38.29 in Shanghai. That's almost $2 higher than COMEX. That's arbitrage, folks. That's the East baiting the West into coughing up physical metal. And it's working. But let's switch gears and talk about the miners, because this is where things could get truly insane. Gold's up, silver's up, yet the miners are still dramatically undervalued versus the metals. GDX is around $50, still well below the 60 to 70 levels from 2011. And that was with gold at $1,900, not $3,400. Why? Because miners have been starved of capital for over a decade. ESG constraints, hostile governments, permitting nightmares, all of it's kept supply growth anemic. Meanwhile, their costs are largely fixed, so every dollar that gold or silver goes up above their cost basis is pure margin expansion. That's why historically, when metals enter the parabolic phase, miners absolutely rip. We saw this in 1979, we saw it in 2010. Miners didn't just outperform gold, they often delivered 3 to 5x leverage. And right now, technically, the gold and silver miner indices are sitting right on the edge of massive breakouts. You plot the GDX versus gold spread since 2020, you'll see a compression that's tightening like a spring. Once that breaks, it could mean explosive upside. But here's what's different this time. And it's why I don't think we'll see the usual spike then crash. The monetary backdrop is fundamentally changed. When gold hit $850 in 1980, it was a blow-off top. Fed Chair Paul Volcker jacked rates to 20%, slammed inflation, saved the dollar. When gold hit $1,920 in 2011, the Fed wasn't tightening yet, but the market feared they would normalize. Today, we can't normalize. We can't raise rates to crush inflation. We can barely hold 5% without breaking the banking system. The government's adding debt at a pace that makes higher rates politically suicidal. That means we're trapped. We're stuck in negative real rates forever. That's rocket fuel for gold. As Luke Groman likes to say, there are only two kinds of sovereigns, those that print and those that default. The US isn't going to default outright. They're going to print. They're going to inflate away the debt. And that means gold doesn't spike and crash. It spikes and then stays there. It becomes the new anchor. Now, could we see some short-term volatility? Of course, expect it. The bullion banks will play their games. The BIS will intervene. You'll get raids on COMEX that knock gold or silver down 5% in a day. That's how the game's always played. They need volatility to shake you out. They need you to panic, sell your real assets back to them. But pay attention to who's buying on those dips. It's not retail. Retail's still chasing meme stocks. It's sovereigns, central banks, family offices, big private capital. They're the ones standing for delivery at these suppressed prices. And look, we're seeing cracks in the paper game itself. The ECB last month openly warned that gold derivatives pose a systemic risk to European banks. That's code for, we're worried about a delivery crisis. Because unlike the US, where banks can be backstopped by unlimited Fed liquidity, the Eurozone is far more fragmented. If a big counterparty blows up because they can't cover physical gold delivery, you could see cascading failures. That's why Singapore is opening its own gold exchange. That's why Saudi Arabia is building vaults. That's why BRICS are talking about trade settlement systems that bypass SWIFT entirely. They're prepping for a world where paper promises fail and only metal counts. So yeah, I'm wildly bullish. But more than that, I'm sober. Because this isn't a game. This isn't speculation. This is about survival of purchasing power. You don't own gold or silver to get rich. You own it so the system can't make you poor. We're heading into a phase where people stop caring about the dollar price of gold. They'll just want to know, do I have ounces? Because in a real currency crisis, there is no meaningful dollar price. The dollar itself becomes the question mark. And if you're sitting on metal, you're going to be in the driver's seat. You'll be the liquidity. You'll be the counterparty risk-free asset everyone scrambles to hold. So I just wrap up by saying, ignore the noise. Ignore the short-term raids, the manipulated dips, the talking heads telling you gold's in a bubble. Look at the trend, look at the flows, look at who's buying, and then ask yourself, who do you want to stand with when the dust settles? The meme traders and paper gamblers? Or the sovereigns who are vacuuming up every ounce they can find? I know my answer.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.